Good morning, everyone. Thank you very much for joining us. With me on the panel today is Rian Dafel, our CFO, and Jaco Skuman, our COO. We're going to take you through the presentation, and then we'll have a short video, and afterwards we're happy to take your questions. We are doing this webinar from an overcast and rainy Johannesburg, and having grown up in a farming community and having prayed for rain as often as I did, I find myself intuitively happy when it rains, but now that we have a 60 megawatt solar farm, I'm also looking out for a bit of sunshine. So with half sun, half rain has become my latest preference. But be that as it may, let's get into the presentation. And I'm going to go straight into the third slide, where we give a summary of the highlights for the half year ending, December 24, assuming that you've had a look at the disclaimer. The highlights, obviously, for us is the fact that this is the 18th year that DRD is paying a dividend, and it's very much part of our value proposition. I think dividends for us is no longer just a policy, but it's become a value, forming part of our value proposition composite of maintaining healthy cash flows or focusing on cash flows whilst taking full exposure to the gold price and offering shareholders also the opportunity to trade a stock that's steeply geared to movements in the gold price. It's very specific, it's very deliberate, and we do believe that those who are shareholders in the company and that are long DRD, that this is typically what they would require. I think paying a dividend also and focusing on paying a dividend requires financial discipline, and that financial discipline flows through also in the way that we manage our costs. So getting into the essence of the presentation itself, as you could see that the financial performance of the business has been good, and that's on the back, obviously, of steady performance. We'll elaborate a little bit on the operating performance for the last 6 months and compare that to some of the previous periods. But in order to take advantage of a very healthy gold price, you need to be able to produce, and our operations managed to do just that. The result being a 20% or 28% increase in revenue to just over 3.8 billion rand, a very healthy increase in operating profit to 1.5 billion rand, 74% increase, and headline earnings increasing by 65% to just under 1 billion rand. And that, plus the fact that we didn't have to dip into our credit facility, means that the company is still in a healthy cash position, just north of 600 million at the end of the period, and that's enabled the board to declare a dividend that represents a 50% increase on the previous interim dividend, up from 20 cents per share. This time around, it's 30 cents per share. Operating performance, the Ergo profile, and I think that's the main change that we've seen. The operating profile at Ergo has obviously changed from between 2 years ago to now. We were, I think, really getting to a point where we no longer wanted to tell the market why we didn't achieve volume throughput and why we were still waiting for licenses and so forth and so forth. The decision was taken to extend the Ergo life of mine after its first phase, after it depleted its initial life of mine, so to speak, the one on which the initial acquisition and capitalization of Ergo was based in 2007, 2008. And we've now managed finally to get all of those licenses and all of the sites that are necessary to deliver into its current operating requirements to fund the capital reinvestment program that we'll go into more detail a little bit later. All of those are now up and running, and Ergo is actually running at a slightly throttled volume throughput rather at this point in time. Part of the program going forward involves having to extend its tailings deposition capacity. The tailings dam that we've been using now since the inception of Ergo, it is in a mature phase. It's not going to be able to maintain the deposition rates that we require for very, very much longer. So we deliberately throttled back our throughput rate to 1.65 million tons per month. It is up, though, quite significantly from the previous period, as you'll see later on. But the entire profile of Ergo has now changed to the higher volume sites and slightly lower head grades. And that's the offset that's required for an operation going into the phase that it's in now, of lower head grades but higher throughput, and in that way bringing down your rand per ton profile. So a different throughput profile, mostly lower grade, slightly reduced yield, but offset by the reduction in cost per ton. Cash operating cost was consistent on a per kilo basis, was consistent with the inflation rate, or not higher than the inflation rate. But that, of course, also was assisted by a change in the cost profile, which I'll elaborate on a little bit more deeper into the presentation. In moving on to the sustainability aspect, you can see that we've seen a 16% decrease in electricity from external sources. That basically means Eskom. So we used 16% less power from Eskom, notwithstanding the fact that total power usage increased in order to accommodate for the higher tons. And that is because of the commissioning of the Ergo solar plant. That's up and running now. It's been successfully commissioned, and we'll also deal in greater detail on how that is contributing to the future plans for Ergo. As I said earlier, Ergo was actually through its initial life of mine, and part of the capital reinvestment that's required in order for us to extend that life of mine to cover a larger proportion of its existing resource was to build the solar farm, and that's now been done successfully. Solar farm is an important part, and an expansion of its tailing storage facilities another important part. You also see that in terms of environmental management, we're still seeing an ongoing vegetation of tailings dams. With the rains being a little bit late last year, we saw a slight increase in the total number of dust exceedances on the monitoring points that we manage or that we monitor. That has obviously now been superseded by very, very healthy rain. So at least that part of the business is where it should be at this stage. So a slight increase in potable water consumption, but as you'll see later on in the ESG slide, the trend in terms of potable water usage has been a very healthy trend over the last few years. In terms of Far West Gold operations, that's been very, very steady. Its tonnage throughput's been steady. Its recoveries have improved, and that also contributed towards the increase in total production to 2.5 tons for the half-year period. So moving on to the next slide, which is the purpose and vision slide. And this is where we want to talk a little bit about what it is that we want to achieve over the next few years to set up the business optimally to take full advantage of our resource endowment. And we've coined a phrase called Vision 28. It's not particularly original, but it says everything that it needs to say. And that is where we want to be in financial year 2028. And the whole idea is to, by then, have established capital infrastructure that can sustain a throughput rate of 3 million tons per month, up from just over 2 million tons currently, and to take gold production up from just north of 5 tons per year to 6 tons per year. So just over 200,000 ounces per year. That is the target, and that is where most of our efforts and a lot of capital is going into at this point in time. Spoke about where Ergo is in this interim phase, having moved out of its core sites into the existing combination of sites, and it is now running at a throttled throughput rate of 1.650 million tons per month. The idea being for it to go back to 1.8 million tons as and when its tailings storage capacity has been expanded, it's been extended. We talk a little bit about the Withok the Withok tailings facility and the work that's being done in that regard later on in the presentation. At Far West Gold, it's really just the phase 2 that we've been talking about ever since we acquired the Far West Gold recovery operations from Sibanye-Stillwater. We started off with the first phase, a plant that has throughput capacity of 600 million tons per, 600,000 tons per month, to take that up to 1.2 million tons. We've been mining it at 500,000 tons per month, once again, because of the rate at which we could responsibly deposit onto its existing tailings facility. Part of this expansion, part of phase 2, obviously, is also the construction of the regional tailings storage facility, which we started with in June of last year. We'll give you some insight into where we are in that regard as well. But ideally, where we want to position ourselves is to, in 2028, financial 2028, be in a position to maintain these throughput rates, achieve this output based on what we're seeing in terms of available ore body, in terms of available mineral resource. By then, capital would have been spent, so there will be a sharp reduction in capex because of the nature and the construct of reclamation activities. We believe that the trend that we're seeing in terms of rand per ton will continue, and then we'll have the benefit of that additional ton of gold, the revenue associated with that. So we do believe that this would constitute significant step change for the company as and when this materializes. Moving on to the next slide. As I said, a big part of positioning Ergo for its second phase, for this next phase, was the construction of the solar farm. And we've stayed up to date with regards to communications in this regard. The main thing is that late last year, the second phase of the solar farm, to take it to a 60 megawatt solar farm, that was put into effect, that was commissioned. The BESS system, or the battery energy storage system, that was also commissioned, capacity of 160 megawatt, that was approved, it's now running. And we've been systematically brought it into the operations. And I think it's important to understand that what this plant's doing and what we embarked upon is really activity at 5 different levels. So firstly, Ergo generates power through the solar farm. Secondly, it stores power through the BESS facility. Thirdly, it draws power, and there's no meter between the solar farm and where the plant, where power is being used, and also the Brakpan tailings facility where power is being used. So it draws power from the solar farm and also from the BESS facility. It also evacuates power into the grid. And in one part, some of the power that goes into the grid is offset against other Eskom accounts that are held by Ergo itself. So there's an offset component. And now it's also wheeling power into the grid for the benefit of Far West Gold Recoveries, or for the future benefit of Far West Gold Recoveries. So as and when the Far West Gold Recoveries account's been transferred into the name of Far West Gold Recoveries, there will be the benefit of wheeling as well. So all of these things, all of these different activities at these 5 levels, this is the composite of what we've involved ourselves in terms of this particular facility. It's a wonderfully complex facility. It self-balances basically in terms of where power is being drawn from and in line with what its particular power requirements are at that particular point in time. We've had a change in thinking also after Eskom's performance improved during the course of last year, and when we saw less power interruptions due to load shedding. And of course, we didn't have to we weren't load shed, but we had to reduce consumption of power by 10%. So that was a power curtailment arrangement that we've always had with Eskom. But we were going to draw less power in the eventuality that there would be a requirement for reduced usage or even power cuts due to load shedding. That hasn't happened, and as a consequence, we can actually draw the batteries down to a much lower level, knowing that we'll be able to recharge them during off-peak, during the early hours of the morning, late nights and early hours of the morning. So that's changed the usage profile a little bit, and it's to the advantage, it's to our cost benefit. Being able to use more stored power at night time. At the moment, we're still talking about approximately 15 Rand per ton cost saving. It's an estimate based on the calculations that we did on power usage going forward. We are seeing these sorts of numbers, but in view of the fact that this is not a facility that is being used exactly the same way every single day, every single minute of the day. There is no household that actually does that. There's no factory that does that, that runs 100% at a particular sort of draw for the entire period of time, considering also that we're talking about these 5 different levels of consumption. So to give an exact number of the amount that we're saving at this point in time, it's not quite that easy. We can say that we've saved 16% on, or that we used less, 16% less than last year for the total business. But it'll be interesting to see exactly what this benefit is. In terms of that range, that 9 to 15 Rand range, as and when everything that needs to happen in order to see the full benefit is in fact being put into place. The one thing that we haven't quite seen is that not all of the power units that's been evacuated into the grid is reflected on the Eskom accounts that we receive. So there's definitely a bit of an account reconciliation that needs to take place there. On the 1st of April or thereabouts, maybe the 1st, maybe the 2nd, there will be a webinar. And then we hope to be able to, ex post facto, give a better summary of the exact savings that we've had. But you'll see, as and when Rian takes you through some of the cost profiles, that the financial benefits are most certainly there. We know how much we've generated, we know how much we've used, we know how much we've put into the grid. It's interesting to see exactly where the numbers end up as and when these accounts have been reconciled. There have been a myriad of tests to make sure that we can responsibly evacuate into the grid. It's called the retake test work. That seems to have come to an end now. So hopefully all of that will now become a little bit more clear as we go along. Second part of ERGO, in terms of setting it up for the future, is the recommissioning of the Withok tailings dam. It is a licensed site, but a whole host of regulatory requirements need to be met in order to restore the site and to once again use it as an active deposition site. It's designed for 310 million tons, and the initial work has started in terms of public participation. That first meeting went well. We've also done some of the initial scoping for the water usage license that's going to be required. So again, there'll be engagements with the Department of Water Affairs and Sanitation. In fact, there have been engagements with them, as well as the environmental approvals that's required for the recommissioning of this. So that work's happening, and we hope to have the design submitted by July 2025. That's a very important part of making sure that ERGO can continue, and that at some point into the future, as and when this facility is up and running, we can go back to 1.8 million tons per month. Moving on to Far West Gold, the work that's happening there. On the left-hand side, you can see a picture of the construction work that's been happening on the regional tailings facility, the RTSF. Here at the bottom of the picture, I hope you could see my cursor over there. Those are the two of 4 return water dams. I can tell you that those return water dams are larger than many of the reclamation sites that Crown used to process. Probably not much smaller than the old Topstar site, to give you a sense of scale. This dam is 800 hectares in size. At the bottom corner here, that's part of the initial starter wall. It's going to be 26 meters high. It's going to be 100 meters wide. It dips down from north to south. So the starter wall at the top there is going to be a little bit lower. It's about 1.5 meters high. And we hope to have this in place for commissioning for early occupation during the latter half of 2026. As of now, we've moved just over 2 million cubes of material. That is to both level out the area. These are old maize fields, to level them out. As it is, they're relatively flat, but they need to be leveled to prepare it for the liner, and also with a construction of the initial starter wall. So there's a starter wall, and then there's also whole set of trains, and the initial downstream construction will take place over these surface trains on the outside of the starter wall. It's a wonderful facility. Work on this facility is progressing quite nicely. It's got to be linked up, so it's a very large footprint. It's got to be linked up with a whole network of pipelines, and there you can see some of the pipeline construction that's already been installed. And then to the right there, you can see a picture of some of the civil work. Those are really more of the excavations that's happened. It's actually progressed quite significantly beyond that point. Some of the foundations having been done, CIL plant, the elution circuit, your oxygen plant, etc., etc. That's all happening right next to the existing DP2 plant. There should be some video material in this regard on the website as well. You can have a look at that. But that is going to be taking the Driefontein 2 plant to a monthly throughput of 1.2 million tons. The idea being, as I said earlier, for all of this, we're going to early commissioning by late 2026. The civil work there, the engineering work there is working to plans, working to schedule, and it's very encouraging, the progress that's being made in that regard as well. So, moving on to the next slide. Just reactivate the remote, and then I can move on to the next slide. There we go. So, operating performance for the 6 months. These are very encouraging, but you also see how the basic construct, the basic composition of what we're doing is changing, especially at Ergo. So the first block on the left-hand corner, there you could see that volume throughput, notwithstanding the fact that we're throttling, is up quite a bit from the 2 previous half-year periods. And that really is not indicative of really the capacity of Ergo at this point in time, but really just the extent to which we were hamstrung by the delays that we experienced during the first half of 2024 and the second half of 2024, when we were waiting for those licenses to come through that we started applying for in 2018. So now they're all through, they've all been done, but there is an interesting consequence to the fact that we've had to rely so much on cleanup material and reclamation material. So whilst the yield is entirely expected, I believe that it would have been marginally better if we still had some of the legacy material to trickle into the feed. So we are where we wanted to be, considering our circumstances of the 2 previous years. We have increased our volume throughput because we do have access to the new sites. They are lower grade sites there, though, and there you could see that in the yield itself. Obviously, the cost per ton is significantly lower. Because of the fact that this is mostly through monitoring, through the hydro mining, but the fact is the profile is definitely a changing profile, that the lower yields being offset by lower unit costs to more or less maintain margin. And there you could see the production as well. So more tons, lower head grades, giving us exactly the same output as we saw in the first half of 2024. And that's really the major difference between surface reclamation and primary mining. So in primary mining, your typical cycle is once towards the maturity of a mine where your cut-off grade goes up and your volumes go down. And our environment is the exact opposite. As your grades come down, you have to increase your tonnage throughput in order to manage your unit costs and maintain your economies of scale, basically changes. Now, once Withok's up and running, and once we've restored tailings capacity and we can go back to 1.8 million tons, the footprint of Ergo would look considerably different by then as well. We've been systematically reducing the number of active sites. It's gone down from 15 to about 10. It'll go down even further as we get closer to 2028. And then the cost per ton, which is on the next slide, if I'm not mistaken. Let's wait for it. There we go. Sorry, no, this is Far West Gold's operating blend. But maybe just to conclude those remarks on Ergo, cost per ton would then come back further because you would have seen full benefit of the solar farm, a lot less in terms of mechanical hauling and lifting, far more in terms of hydro mining, and we'll see a relatively flat margin. In fact, there was a presentation towards the latter part of last year where we showed how this stacks up, how the higher volumes but lower cost per ton, how that balances out, how that evens out not dissimilar to what you're seeing here. Just go back to the previous slide. Just wait for the system to respond. There we go, where you see this sort of number, where although that is different comparatively speaking, the yield and the volume, see that the production remains relatively flat. So it's where the offsetting, because all of these things contribute in a different way, where you get to more or less a flat profile. So moving into Far West Gold, its operating trends, it's obviously a different story altogether. It has one active site, plus one active reclamation site and one cleanup site. So the number 5 dam has been mined out. Number 3 dam is now running at full revs, and you can see the volume throughput there is pretty flat. It stays at just north of 3 million tons for the 6 months. The yield is improved at the number 3 dam, so that first layer, that top layer, has been mined out. It's now going into the deeper regions of the dam, so the head grades are improving, and this plant's also performing really, really well. And there you see it also in the production numbers, up from 660 in the comparative period to 720 kilos for the period. So both of these operations actually responded really well, Far West to the commissioning of the number 3 dam, and Ergo also now to the commissioning of its 4 new sites since 2024. Moving on to the next slide. Give the system a moment to respond. And this is the financial performance part of the presentation, and I'll hand over to Rian to take you through those numbers. Thank you, Rian.
Thank you very much, Neil. Good morning, everyone. Thank you for joining us on this virtual platform. This time round, again, it's my privilege to take you through the financial performance of DRDGOLD for the 6 months ended 31 December 2024. As you know, most of our analysis happens to the comparative 6 months period ended 31 December 2023. And I always refer to our booklet that we take great care to prepare. So I encourage you to go and read. Obviously, we can't cover everything in this highlights presentation. As I always do at the start of my section, is just recognize the people behind the numbers. As I said, it's my privilege to talk you through, and I love doing that. I really want to recognize all the employees, contractors at DRDGOLD, either working in operations, busy with our vast project CapEx, growth CapEx that we're incurring, or in support. I believe all equally important for us to tirelessly pursue our purpose of reversing the environmental legacy of mining, rolling that back, improving quality of life. And as you know, that requires large volumes of material to be moved over a very long period of time. And I know our teams work relentlessly, literally 24 hours a day, to achieve that. And I recognize the team at DRDGOLD for this performance. And Neil mentioned, and I looked outside, it is still raining. But at the start of the financial performance slide, may I say that what I will present, I believe, is rather sunny, and very proud to present it. So on the Ergo financial results side, Neil always provides perfect background for me just to take everyone through what that means then financially for Ergo, Far West Gold Recoveries and the group. And may I again say that, sure, these are really good trends to talk to. You'll see it on this slide and also in the following slides. And it's a positive trend that I can talk to. So for Ergo, again, looking at the comparative period 23, so the first 6 months of the 2024 financial year, and the first column compared to the third column, for the current 6-month period that ended 31 December 2024, we see a revenue increase of 24%, obviously aided by a raise or an increase in the gold price to just under 1.5 million, 1.48 million rand a kilogram, with gold sold down period on period by 2%. But as Neil alluded to, in this same period, the volume for Ergo was up 22%, with the yield then on the sites that we're now tackling, obviously slightly lower grade, but higher volume. But really good revenue picture. On the cash operating cost side, even better. And here it is so encouraging to see that what we anticipated and what Neil specifically talked about at our August results is coming true. So as you can see, costs period on period only up by 5%. And clearly that is one reason for that is the decrease in machine hire costs. And then electricity costs only up by 3%, which I believe is a good result, also considering the volume up by 22% and double-digit increases in Eskom rates. And then the combination of revenue and cash operating costs, and again, just look at the leverage that it creates. Operating profit for Ergo up 92% to 828.7 million rand. So really good performance by Ergo and compliments to the operating team. Moving on to Far West, very stable performance. Gold sold for Far West for the period up by 10%, and you saw some good yield increases, tons stable. And that resulted in revenue with the gold price increase of 26%. Revenue increased 39% to over 1 billion rand for the 6 months. Cash operating costs also stable, just up by 8% period on period. Obviously inflation increases and then higher than inflation increases in areas like security and labor costs. Again, those two in combination with some small gold in process adjustments gets us to an operating profit up 57% from the comparative period to 750 million rand for the 6 months ended 31 December 2024. Again, great solid performance by the Far West team, which we're very proud of. Then putting that all together for the group, as I've mentioned, really wonderful trends that really talks for themselves. You can see the operating margin, and again, I've mentioned it to a couple of people in the last little while. Although we're close to the business, we sometimes underestimate that impact. So if you can keep your costs under control, which is what we've done in this 6-month period, and you have a solid performance plus gold price increase, so the operating margin grows, and that margin obviously flows through to the bottom line. So operating margin percentage increase, very positive. All-in sustaining cost margin, obviously on the back of the operating margin, but you would see in the booklet, obviously less sustaining capex, and that's not necessary for us anymore with our focus on growth capex. So that increases the all-in sustaining cost margin. And really encouraging for us is free cash flow. So obviously we have a huge capex program. You would see our cash capex for the period just under 1 billion rand. But because of the good operating performance and high gold price, we still generated free cash flow for the 6 months, which is a wonderful performance. And all of that, as I mentioned, high gold price, good operating performance, costs under control, all of that flows to headline earnings per share, up 65% period on period to 112.6 cents per share. Then moving on to the income statement or statement of profit and loss. To summarize, revenue for the period up 28%, and with costs under control, up 13% period on period. There's a depreciation increase, more sites, obviously the solar coming through there as well, leaving us with gross profit from operating activities up 72% to just over 1.3 billion rand. Administration expenses and other costs stable. Finance income slightly higher with the additional cash that we generated. There's also a Rand Refinery dividend included in that 132.8 million rand. And finance expense mostly, as you know, in the income statement, the unwinding of our rehab liabilities, and only a very small portion of cash finance costs, and mostly around securing our facilities. Income tax, 337.1, mostly deferred tax. The operations don't pay current tax at the moment because of the large capex investment that we make and the capital deductions that we are allowed. Taking it all to the bottom line, profit for the period, as Neil mentioned as well, 970.1 million rand, up 65% period on period. Then on the statement of financial position, or previously called the balance sheet, again, wonderful trends, as you can see there, if you look at the property, plant and equipment line. So from December 2023, up more than 3 billion rand. So essentially, as you know, what we've done there is taken the cash, the 1.5 billion cash in that line, and financed our solar farm and battery infrastructure, all of our own cash on our own balance sheet. And then other increases around the projects, the capex growth projects that Neil alluded to. Non-current investments and other assets, rehab funds that we continue to invest in a very responsible way, and also mostly our investment in Rand Refinery. Cash and cash equivalents, we'll elaborate on the next slide. Current assets, current liabilities, quite stable across the 3 periods. And then, as I've mentioned, it's great to see total assets and equity growing over time. Deferred tax liability that I alluded to in the income statement is something that we'll see growing as we utilize our capital deductions. That in effect says that at some point in the future, we'll create revenue without a relating capital tax deduction. And that's what that deferred tax liability tries to illustrate. And then overall, a very, very healthy current ratio still of 2.3 at the end of December 2024. Then love ending off. So I always say with my favorite primary financial statement, the statement of cash flows, is something that we've focused on very heavily and will continue to focus to make sure that we generate cash while we grow our business. And as Neil said as well, that we can make sure we want to reward shareholders, even though we are prioritizing any cash that we generate towards our 10 billion rand capital program over the next couple of years. But take a look at cash generated from operations, more than doubled in the comparative period to over 1.2 billion rand. The dividend received that I alluded to is from Rand Refinery. Then finance expenses, very small. It's literally the facility fees that we have to have our 2 billion rand, up to 2 billion rand facility with Nedbank in place, which we haven't utilized up until now. And then income tax, nothing for the operations, as I've mentioned. And then there's the number, the cash capital expenditure or acquisition of property, plant and equipment of 947 million rand for the period. Going down to the financing activity side, the 172 is the dividend, the 20 cents, the dividend, final dividend that we paid in September. And we're very proud to follow that up with the 30 cents interim dividend that Neil alluded to. So overall, as I've mentioned, we did not tap into any cash resources, so that has grown to 661 million rand at the end of December 2024. So really, really healthy cash position and cash generated for the period. Then the handover slide, where I'm going to hand back to Neil, and he can elaborate. My reflection is just for this distinct period. So let's say from the beginning, end of August, beginning September, quite a healthy increase to where we stand now. Let me hand back to Neil then to continue the presentation.
There we go. Thank you very much, Rian. So yes, we are encouraged by what's happening with the share price. Said earlier, a big part of our value proposition is a share price that's deeply geared to the gold price, but we also want to make sure that we are that we're in the right range, and at some point the underlying value of the company finds its way into that range, and we'll continue to work hard to see if at some point, in anticipation of what we believe could be potentially very attractive towards 2028, that range moves to a different level, a more attractive level. So moving on to the later stages of the presentation. Just wait. So we're going into the sustainable development part. It is a very important part of the business. We do give you some of the headline numbers here. We continue our environmental spend. This is something that we've just been keeping at these levels right from the outset. We're firm believers in concurrent rehabilitation, so that as and when the cash flows are over, that the rehabilitation is also towards its end, that you don't have that massive liability that matures right at the end after you've sort of run out of cash flows. So this is something that I think distinguishes our company. Also being right here in the middle of the largest sub-Saharan city in Africa, it's important that we keep these standards high, because if we do it wrong, then the societies around us, their quality of life is affected. So it's a very, very close correlation between our standards of environmental governance and the quality of life of those communities who live in proximity to our operations. This will continue. 28 hectares of vegetation that happened this 6 months. It's up from 15. Potable water consumption, and this is the number that I was referring to earlier. You could see, comparatively speaking, the 31st of December 2022, 1,388 million litres. 1,388. There's 1.3 billion litres of potable water usage in the 6 months up to 2022, December 2022. It's more than halved now for this current financial year, and that trend is one that ought to continue as we further expand our closed water circuit and drawing from alternative sources. Very little potable water is also used as processed water. This is by and large for vegetation, and also for use in ablution and other use, personal use in our at our plants. Dust emission exceedances are reflected on that, and also the late rains, but that's not been restored. And here you could also see the trend, very healthy trend in terms of external electricity consumption, down from 173 to 141,000 megawatt, and that trend will continue as we see the impact of the solar farm becoming more and more embedded, and for a longer period of time, obviously now going into the second half of this financial year. Closely correlated to that also the carbon emissions slide. So in terms of environmental performance, I do believe that we are living the values that we profess to have. Moving on to the next one, the social performance here once again, very deeply embedded as part of our commitment to sustainable development. As you can see, all of these initiatives are associated with self-empowerment. So this is the provision of knowledge, the provision of materials, training of people to set them up in a way that they can self-empower. And we definitely are now moving also into more sophisticated levels of social capital, of that one step up from the initial subsistence farming or the subsistence growing of crops to life skills, business development skills, and hopefully ultimately also to find its way into broader society generally in terms of the environment and optics of those societies, and creating something not dissimilar to what we have. So we have a circular model. We firmly believe that by assisting communities to learn these materials, that theirs too could become a circular model, that the inflow of capital on a monthly basis through social grants and the little bit of money that's earned into these communities, that it stays in that community, that it gets spent 4, 5, 6 times over, that it doesn't land in that community and then find its way into Pep stores or Checkers or one of those, but there's in fact a repeat spending within the community itself. And that's very much what we're trying to achieve with our social reinvestment programs. Good, and then moving on to the next slide. See, there we go. So this is the looking ahead slide, and none of the guidance that we issued earlier in the year has changed. So we still stay within range with regards to production. Same applies to cash operating costs. See by extrapolating the numbers that we reported here, that we stay within range. Then in terms of Ergo, obviously it's all systems go to make sure that we submit all of the materials that are necessary for the permission to start construction at the Withok Tailings Facility. And I did make the point earlier on with regards to wanting to submit the design by July of 2020, by this July, in order to be in a position to commence with construction next year. And then, of course, we also want to make sure that we take full advantage, not just in terms of consumption, but in terms of the financial treatment of, which is basically the reconciliation of the accounts, that this also happens during the course of the 6 months. I know from my own personal experience, after I'd equipped my house with solar, it took a few months before that account was reconciled. So it does get reconciled ultimately. We know what we consume, we know what we generate, we know what we push into the grid. It's now a case of making sure that the accounts reflect that over time. Always gold recovery, all systems also, and all the focus both on RTSF and getting DP2 to where it needs to be for latter part of 2026, whilst at the same time maintaining its encouraging throughput and output profiles. Then finally, just a very brief slide on delivering to our purpose. And that is something that I think you're familiar with, of what it is that we want to do. So DRD Gold, the gold producer, but one that is increasingly finding itself within a circular model. So not creating any new waste, but producing gold from mine waste, from material that's already been deposited. So waste neutral, increasingly relying on renewable power, a very strong social capital focus, and the restoration of land previously sterilized by mining activities. Ladies and gents, that's our presentation for today. We have a video which we'd like to show you, just in terms of it's a bit of a taster before we do the webinar in April, and then after the video we'll take your questions. We see that a few questions the questions are starting to come through. Thank you very much for attending and listening to the presentation. So there we go. Thank you very much. So that's a bit of a teaser of what's to come on the 1st of April, when we intend to also give you a very nice breakdown, ex post facto, of the savings that we saw, the consumption numbers that we saw at the solar plant from inception itself. We're not doing it now. We're giving you numbers on the consolidated basis over 6 months, but the intention is to be in a position to take the data that we're collecting, that we have collected, and that we have been collected, and that we will be collecting for the next month and a half, and to give you a detailed picture of all the variables and where we've landed in terms of actual savings. I'm going to go through the questions and answer the ones that I can, and the ones that I cannot, I'll pass on to my colleagues. And I think I'll start with the first one from Peter Kromberg, who wants details on the terms of the 2 billion rand Nedbank facility. Rian, if you maybe want to take that question and just explain what the terms are of the Nedbank facility.
Sure. Thanks, Neil. Thanks for the question, Peter. So yes, end of July last year, we established the terms of that facility. So simplistically, it's a 500 million rand overdraft that is available to us anytime, and then a secured 1 billion rand facility, a revolving credit facility over 5 years. And that's I think the positive of that is that it matches our sort of medium term capital program. So it's not only a 2 or 3 year facility, it's a 5 year facility. And then that revolving credit facility has an accordion option, so a 500 million rand accordion option. So the 1 billion secured plus the 500 plus the 500 million overdraft then gives us the 2 billion rand overall facility with Nedbank. Thanks, Neil.
Thanks, Rian. So then moving on to the other questions. There's a question from Nick. DRD calculates a tax rate based on forecasts of profitability. And I think this is your favorite subject, is deferred tax. So he wants to know whether the tax rate that we currently use, in view of the fact that the current H2 outlook must be a lot better than what we anticipated, whether the tax rate that we use now is still, does it still match the current financials, or should you use a different tax rate?
So thanks for that, Nick. And as you rightly say, Neil, I love talking about the topic. I don't know if I always find the right audience to do it, but if there's a question, let's go for it. So Nick, you're quite right. So what happened last year is that we upped the deferred tax rate for Ergo. So last year for the 32 2024 results, from 22% to 25%. So you're quite right. So that is an indication, because of the gold tax rate formula, of future profitability of the operation. What it does then, obviously immediately, based on deferred tax principles, it charges the income statement on that increased rate. So and then, as you know, we go through annual revisions of our life of mine estimates, rehab, all of that. So on a half year basis, on an interim basis, we just do checks. So we don't do a formal review, because as you know, it is quite a lengthy process. So we haven't, again, updated any deferred tax rates looking forward. We believe that our estimates previously still stand. So it's 25% for Ergo, and Far West Gold Recoveries at 29%. So we hopefully that answers the question, and that roughly gives you that estimate of deferred tax that we calculate for the 6 months to 31 December 2024.
Thank you. Thanks, Rian. There's another question from Nick with regards to CapEx. So the CapEx guidance for 25 financial year was 3.5 billion, and I think we were sort of bumping against 1 billion by the end of the 6 months. And Nick's asking whether the 3.5 billion is likely to be achieved. I suppose, firstly, you don't spend your CapEx in 12 equal amounts. You don't take your total CapEx forecast, divide it by 12, because your capital spend is not linear. There's some big cost items that need to come through. Having said that, it's unlikely that we'll spend the full 3.5 billion, but the extent to which we'll fall short of that, I think at this stage is not entirely clear, because there are still a few very large items that need to come through. With regards to where the programs are tracking in order to achieve the outcomes that we set for ourselves, the delivery into the larger, longer-term vision, we're encouraged by the trending of where these programs are. So yes, CapEx might fall a little bit short, but I do believe that we're trending favorably in terms of actual execution. Rian, I don't know if you want to expand on this, if you want to give any additional detail.
No, I think that's right, Nick. And you saw it previously. We generally have a trend where we seem to look behind, or we seem behind by 31 December of each of our financial years. We do catch up in inverted commas. Some of that, as Neil said, it's all long-term projects. Sometimes it spans a couple of months. So we do expect to, again, in inverted commas, catch up some of the 3.5 billion. We probably won't get there fully. But that's not always necessarily an indication of the stage of completion of the project or where we want it to be. So we're not worried from that point of view. So technically, from a cutoff point of view, 30 June we may fall short, but we're not worried. We do look at it as a 2 to 3 year capital program that we are managing.
Thanks, Rian. Nick asked a question about the capital costs of the solar farm and the BESS, which I'm going to hand to Jaco. He also asked a question about the realized savings on a per ton basis at Ergo associated with the solar farm. So Nick, we haven't prepared for purposes of this presentation. So there's a bit of a disturbance. I hope you can still hear me. There's a bit of a background noise. Let me just switch the video. There we go. All right. So in terms of the savings, we did not prepare detailed numbers on a for the month or for the exact period. Having commissioned the solar farm during the course of the 6 months under review, and we've done it specifically because we don't want to come up with another estimate. I think the next time that we want to report on the actual numbers per ton, we want to be able to give you on an ex post facto basis. So these were the trends. This is how much we consumed. This is how much we exported. This is what was recognized in terms of our accounting. So this is the exact number per ton for that period. It's not going to be exactly the same every day. It's not going to be exactly the same every month. But we'll be able to give you some insight into the trends that we're seeing. What we can say is that we're not off target in terms of the ranges of our estimates. So it's definitely trending in accordance with the ranges that we've offered. And what we can also say, just in terms of on a consolidated basis, just looking at the whole picture, is during the 6 months we used 22% more electricity units. If you compare the actual usage of electricity for the 6 months to the end of December 24 to the 6 months of 23, 22% more electricity units were consumed for the output that we achieved. However, the amount of power that we imported from Eskom reduced by 16%. So already you can see there was a fairly significant swing, and that's notwithstanding the fact that we only had the benefit of the solar plant or the sales for 60 megawatt from roughly the beginning of November. Before that, it was the first phase, it was 20 megawatt, and then also incrementally and not 100% consistent every day. We're also reporting 3% increase in total electricity costs for that same period. So 22% more units used, 16% less from Eskom, and a 3% increase in total electricity costs. And that is not normalized for the Eskom increase that we saw year on year. That is actual numbers compared year on year. So from that, Nick, I think there's maybe some information with which one could use to do some sort of a calculation. We've done the calculation, but as I say, it's not the same, exactly the same every week. It's not exactly the same. Well, it's not exactly the same every day. It's not exactly the same every week. It's not exactly the same every month. We want to be in a position where we could give you the contingencies with the accounts having been reconciled, and also with the actual consumption patterns that we saw up until March, to give an indication as to what the key dynamics are that drive this, and how we see that coming through on the actual financial performance on the cost numbers as well. Jaco, the question with regards to the final capital cost of the solar farm and BESS, I think that you've got a fairly good idea as to what that actual number is. If you want to take that question and maybe unpack that a little bit for Nick.
Sure. Thanks, Neil. Yeah, so we ended up on approximately 2.9 billion, taking into consideration rate of exchange. That means we were approximately 2% above budget. Nick.
Thanks, Jaco. But then there's a further question. So the tax we've dealt with. So Herbert Karibe is asking, how should we think about the grades at Ergo? Is this a step change or an anomaly? And do we revert to what we've seen in the past 2 years? Herbert's definitely a step change. The profile for Ergo changes. In fact, I would encourage you to see if you could find the presentation that I did last year on what the changes have been at Ergo in particular, and what we are targeting for financial 2028. If it's not there, then I'll find it and I'll try to get it to you. But essentially, what you're looking at Ergo is a higher volume profile, but a lower grade. So the grades that you saw last year, those were cleanup grades. They managed to get us to a point where we had respectable numbers, but below what we wanted to produce, because we weren't into the new sites because of waiting for licenses to be processed and issued. But now we are there, and the profile going forward would be pretty much along the line of what you're seeing now. The grades are going to be lower, the volumes are going to be higher, and the whole idea is to manage economies of scale. So lower cost per ton, or a positive downward trend in terms of cost per ton, to offset the slightly lower yields, the 0.04 roughly gram per ton lower yield that we're seeing coming out of the lower grades. So Martin Kramer is asking, when's wheeling of electricity to Far West Gold likely to begin? Now we know that's when the transfer of the account itself is going to take place. Jaco, I don't know if you've got a better idea more detailed idea as to when you think that account would have been transferred, and when Far West would actually also have the benefit of those units that have been put into the grid.
Yeah, thanks, Neil. So exactly when that happens, Martin, I'm not 100% sure. We're in the process. It's like Neil mentioned previously. It's a reconciliation of, firstly, of accounts, and then secondly, also a transfer of the account from Sibanye to ourselves. The wheeling is happening, so we're metering all of that. And then it will be an offsetting of the account at a later stage, as soon as that has happened. So we do anticipate that to happen during this quarter, however. You're just on mute, Neil.
You just have to, there we go. I think I was, thank you. You can hear me now, hey? Seems to be okay. Good. All right, so then the last question that I have is on Zamazamas, and the impact that illegal mines having. So the question is, are there any Zamazamas operating on areas linked to DRD, and what are the implications? So firstly, in terms of the resource that we're mining, we're not in competition with Zamazamas. So they do primary mining, so they go into virgin reef, and they hack it out in some way or another, they put it through a mill, and then they dissolve it in mercury. Our grades are just much too low. So we have in the region of 1/3 of a gram of gold per ton, and the methodologies that they use is just not conducive to that. There are certain areas where maybe over time there may have been some spillages, or maybe some carbon spillages, etc., but those are very, very localized, and those don't really come in conflict with our operations. Having said that, they do operate in areas where we have infrastructure here and there. They do operate, so little outcrops or some of these other areas that they may find attractive. So we do need to be aware of them. Also the holings that they're opening up. Remember, our footprint extends from Crown in the west or central Rand all the way to to Springs in the east. So, and this is along the reef. This is along the Witwatersrand Reef. And these are the areas where they do operate. So we need to be mindful of them in terms of the safety of our staff and also our property. So it's an ongoing topic. Same applies to Far West Gold operations, obviously. They do use shafts to gain access into underground workings. So we need to be mindful of that as well. For as long as those who engage in this activity, as long as they are not removed out of the system and for longer periods of time, and we do think that is starting to happen, where if you get arrested today for stealing gold out of an underground mine, and instead of simply just getting deported and finding your way back into this area, if that cycle is not broken, firstly, and if those who perpetrate these crimes are not taken out of the system for longer periods of time, 3 months, 6 months, 9 months, 12 months, and incarcerated before deportation, and if more severe penalties or consequences do not flow from, again, sort of entering the country after having been deported, after having perhaps served a short sentence for a first offense, then it's going to be hard to really break the cycle. That's the one thing. And as I say, I think the signs are positive that government's taking this on. And secondly, if that network is not broken, if the head of the snake is not chopped off, then we're always going to have to deal with this issue, which is closely also associated, I believe, with the destruction of public property and cable theft and so forth and so forth. These syndicates need to be eliminated, and those in charge need to be locked up. And those who sort of feed the system also need to be dealt with in a different way. But in terms of direct impact in our operations, directly competing with it, that is fortunately something that we have spared because of the nature of our ore body. And I think that is it. Those are all the questions. Ladies and gentlemen, thank you very much for attending this presentation. We hope that we've answered your questions to your satisfaction, and that we also provided you with the details that you require to inform your investment decisions. We can assure you going forward, we'll remain focused not to disappoint and to optimize this ore body for the benefit of our shareholders and our stakeholders as a whole. Thank you very much for attending.
Thank you.